You can start with just $300. That sentence makes some people laugh, not because it is false, but because the internet has trained them to believe that money only counts if it is big, fast, and loud. The phone shows you someone turning a small amount into a huge amount in days. It looks easy, it looks normal, it looks like you are behind. But a lot of that fast money talk is not built to help you, it is built to pull you into action. It feeds on your fear and your greed. It makes you trade more, it makes you chase more, and it makes you think you are doing something smart when you are really just reacting. Long-term wealth is the opposite. It is quiet, it is slow, it is boring on purpose, and that is why it works for the few who can stick with it. This video is called 7 Rules That Can Turn $300 into Millions. That title is not a promise. It is not a guarantee. It is not a trick. It is a way of thinking, a set of rules that give small money a fair shot over a long time, because the real gap between people who build wealth and people who don't is not IQ. It is not secret info. It is not one perfect stock pick. It is behavior. It is patience. It is the ability to stay calm when the screen turns red and everyone starts yelling. If you can build the right habits with $300, you can build them with $3,000 and $30,000 and $30,000 and beyond. If you cannot follow the rules with $300, then more money will not save you. More money will just make the mistakes bigger. So we are going to do this like an owner, not like a gambler. An owner does not wake up and ask, what should I trade today? An owner asks, what do I own? Why do I own it? And what would make me change my mind? And one more thing before we start, these rules are not about hype. I will not tell you what to buy. I will not give you hot tips. I will not tell you that you can beat the market next week. This is about building a simple system that can hold up in the real world. A system you can use when you feel bored, when you feel excited, and when you feel scared. Rule 1, protect the seed. Most people hear investing and they think about growing money. That is only half the job. The first job is not growth. The first job is not growth. The first job is staying alive. Think of your $300 like a seed. If you crush the seed, nothing grows later. In investing, the fastest way to crush the seed is to take a risk that can wipe you out. A big loss does more damage than most people think. If you lose 50%, you do not need 50% to get back. You need 100%. That is a long climb. This is why the best investors are not the bravest. They are the most careful. They do not try to impress anyone. They do not try to win every day. They focus on not making one huge mistake. So the question is not, how can I make this $300 grow fast? The better question is, how can I avoid blowing up? Here is a simple rule you can use before any investment decision. Ask yourself, in plain words, if this drops a lot soon, will I panic? Not should I panic. Not would a smart person panic. Just you. Will you panic? Most people think they are calm, then the market drops and they learn the truth. The screen turns red. The news looks scary. People start saying, this time is different, and your body feels the danger like it is real. So you need a way to keep your feelings from driving the car. Try this inner talk. Say it in your head, slow and clear. I am not here to win today. I am here to still be here in 10 years. That one sentence can save you from many bad moves. Now think about risk in a simple way. Real risk is not price moving up and down. Price moves. That is normal. Real risk is putting yourself in a spot where you are forced to sell at a bad time. Real risk is taking on a bet so big that one bad month changes your whole life. So set a personal rule like this. Never invest money you might need soon. If you might need it for rent, food, bills, or an emergency, then it is not investment money. That is safety money. Mixing those two is how people become forced sellers. And forced sellers do not sell because they want to. They sell because they have to. They sell when prices are low. They sell when fear is high. That is how a temporary drop becomes a permanent loss. Another risk rule is this: avoid any plan that needs luck to survive. If your plan only works if the market goes up right away, then it is not a plan. It is a hope. Hype pushes people into fragile plans. It tells you go all in. It tells you use leverage. It tells you this can't miss, but smart investing is not about can't miss. It is about even if I'm wrong, I can live with it. So make I can live with it your test. Ask yourself, if this goes against me, do I still sleep? That is called the sleep test. If you cannot sleep, your risk is too high for you, even if someone else says it is fine. Now here is the hard truth. With $300, you will feel a strong pull to do something exciting. You will think, what is the point of being careful with such a small amount? That thought is a trap. The point is to build the habit of safety first. Because once you learn to protect $300, you will protect $3,000. You will protect your future paychecks. You will protect the money that actually changes your life. And this leads to the next rule, because protecting the seed is not enough. You also need to know what you are buying. Rule 2, buy a business, not a story. Most people do not buy businesses. They buy symbols on a screen. They see a chart. They see a headline. They see a person online, sounding confident. Then they press buttons and hope the price goes up. That is not ownership. That is renting a feeling. A real owner thinks differently. A real owner wants to understand what the business does, how it makes money, and why it might still be strong many years from now. So here is a simple test. Imagine the stock market closed for 5 years, no selling, no checking the price, no getting out. You are stuck owning what you bought. Would you still be happy to own it? If that idea scares you, then you are not investing. You are trading. And trading is not bad by itself. But trading often turns into emotion. Emotion turns into mistakes. And mistakes break compounding. Compounding is the quiet engine behind long-term wealth. It is like a snowball rolling downhill. The snowball starts small. It looks silly at first. But the longer it rolls, the more snow it picks up. Over time, the growth can surprise you. But the snowball only works if it keeps rolling. If you stop it, smash it, or keep picking it up and throwing it, it never becomes large. That is why business ownership matters. When you own a good business at a fair price, time can work for you. When you own a weak business, time can work against you. So we need a simple way to judge business quality without fancy words. Use this one-page rule. Before you invest in any company, you should be able to answer a few basic questions in simple sentences. What does the company sell? Who pays them? Why do customers choose them? What could make customers leave? Does the company need to borrow a lot of money to survive? Does it earn real cash over time? If the world gets tough, does this business still have a reason to exist? If you cannot answer those things, you are not ready to own it. And if you think, but other people don't do that, they just buy what is trending, remember this: trending is not a business model. A trend can disappear. A business with strong customer value can last. Now let's talk about the biggest trap for new investors. It is not lack of knowledge. It is the need to be part of the crowd. The crowd is loud. The crowd makes it feel safe to buy what everyone else is buying. The crowd makes you feel smart when prices go up, but the crowd also panics together when prices fall. If you want to invest for the long run, you have to accept a strange thing. You will often feel wrong before you are right. You will look boring while others look exciting. And you must be okay with that. So create a simple rule for yourself. No buying something just because it is popular. No buying something just because the price has been going up. No buying something just because you feel left out. When you feel the pull of FOMO, slow down and ask, if nobody was talking about this, would I still want to own it? That question cuts through the noise. Now, to think like an owner, you also need to stop treating news as a command. News is not a command. News is just input. Sometimes it matters. Many times it does not. A long-term owner cares about the big drivers, things like steady demand, strong profits, smart reinvestment, and honest management. The owner cares about whether the business is becoming stronger over time. So your job is T. Learn to separate business facts from market mood. Market mood changes fast, business facts change slower. This is also where patience starts to matter. A good business does not always look good on the price chart. A fair price does not always show up when you want it. Waiting is part of the work. And this is why many people fail. They think investing is picking. But real investing is waiting with a clear mind. Now you might be thinking, okay, I get it. Protect the seat. Buy real businesses. But how do I know if a business is strong enough to last? That is exactly where we go next, because the next rule is about the thing that keeps great businesses great. It is called an economic moat. A moat is the wide ditch around a castle. It keeps attackers out. In business, a moat is what keeps competition from taking all the profits. Without a moat, even a good product can become a price war. Profits can disappear. Growth can fade. And your long-term plan can break. So in the next section, we're going to build a simple moat test. You will learn what to look for in plain language. You will learn how to spot strength that lasts. And you will learn why time only helps you when the business can defend itself. Because compounding is powerful, but it is not magic. It needs the right kind of business. Bought with the right mindset, held with the right temperament. And we are just getting started. A moat is the reason a good business stays good. A moat is the reason a good business stays good. Without a moat, a company can look strong for a short time, then get attacked by copycats, new rivals show up, prices drop, profits shrink, the business turns into a fight, and in a fight, the customer wins and the owners lose. So if you want compounding to work for you, you want a business that can defend itself, You want a business that can stay useful? You want a business that can keep earning good money even when the worst? Sold changes. Rule 3, demand an economic moat. Think of a moat like a deep ditch around a castle. It does not make the castle pretty. It makes the castle hard to take. In business, the moat is what keeps customers coming back and keeps rivals from stealing the profit. Here is the key point. A moat is not a cool story. A moat is not a famous founder. A moat is not a stock that went up last year. A moat is something real that makes it hard for others to compete. So how do you spot a moat without fancy words? Start with one simple question. Why can't someone else do the same thing and take the customers? If you cannot answer that, you do not see a moat yet. Now, use a simple moat checklist. You do not need all of these, but you want at least one strong one, and you want to understand it. One type is switching costs. This means it is painful for customers to leave, not just annoying. Painful like moving a whole system, retraining workers, risking mistakes, or losing time. When switching costs are high, customers stay. Another type is network effects. This means the product gets better as more people use it, like roads, phone networks, or systems where the crowd makes the value. When a network is strong, a new rival feels empty and useless at first. Another type is a cost advantage. This means the company can offer the same value for a lower cost than others. This can come from scale, better tools, better supply deals, or years of learning. If a company can make and deliver cheaper, it can survive price wars that crush others. Another type is brand trust. This is not about being popular. It is about being trusted when the choice feels risky. People pay more when they fear making a mistake. Trust can be a moat. Another type is control of a special path to the customer, a strong store network, a strong app that people already use daily, strong partnerships that TP set. 8 years to build. When a company owns a key path, rivals struggle to get noticed. And sometimes the moat is a real barrier. Rules, permits, or limited rights that make it hard for new players to enter. This can be good, but you still want to check if the company treats customers well, because protection can also create lazy behavior. Now here is the part many people miss. A moat is not forever. Moats can shrink, new tech shows up, people change habits. A bad leader makes dumb moves. A company gets greedy and pushes customers away. So you also need the moat health questions. Ask these. Is the product still needed? Are customers happy or trapped? Are rivals getting better fast? Is the company still improving or just collecting profits? Does the business reinvest in what made it strong? A healthy moat often shows up in simple ways. The company can raise prices a bit without losing customers. The company earns good money without needing huge debt. The company keeps customers for a long time. The company has steady demand even in bad years, and if you are not sure, that is okay. The point is not to be perfect. The point is to avoid weak businesses that depend on perfect conditions. This rule matters even more when you start small. With $300, you do not have room for a big mistake that takes years to heal. You want strength. You want staying power. You want time on your side. But now we hit a new problem. Even a great business can be a bad deal if you pay too much. That takes us to the next rule. And this is where many smart people do something not smart at all. They fall in love with quality and forget the price. Rule 4, use a margin of safety or don't play. Margin of safety is a simple idea. It means you leave room for being wrong, because you will be wrong sometimes. Everyone is. The future is messy. Sales can slow. Costs can rise. A rival see and surprise you. The economy can dip. A great plan can hit a wall. If you pay a price that only works in a perfect future, you're taking a fragile bet. A fragile bet can break fast. So margin of safety is how you build a strong bridge. You do not design a bridge that can hold exactly one truck. You design it to hold many trucks, strong winds, and bad weather. You design it with extra strength because real life is not neat. In investing, that extra strength is the gap between the price you pay and the value you think you get. Here is the clean way to think about it. A business can be great. The stock can still be too expensive. Those are two different questions. So you need a simple way to talk about value without getting lost. Try this. Think in ranges, not exact numbers. You are not trying to guess the future like a wizard. You are trying to say in a normal future, this business might be worth somewhere around this range. Then you compare that to the price today. If the price is far above what seems fair, there is no margin of safety. If the price is below a fair range, now you have a cushion. How do you build a fair range in simple terms? Start with what the business earns and what it keeps. Does it make real profit over time? Does it turn profit into real cash? Does it need to spend huge money just to stay alive? Does it carry heavy debt that could cause trouble in a hard year? Then ask about growth, but stay humble. Many people break their brains here. They assume growth will be fast forever. It rarely is. So use a calm question. What is a reasonable future, not a perfect one? And always ask, what could go wrong? Not to be negative, to be honest. Here are simple warning signs that you might be overpaying. 1. You catch yourself saying, it doesn't matter what price I pay. It's a great company. Price always matters. 2. The story sounds too clean. Every year is amazing. Every plan works. Every new product wins. Real life is not like that. 3. The whole value depends on faraway years. If the business must be perfect for 10 years just to justify the price, that is not safety. That is hope. 4. You cannot explain why the price is fair using basic business facts. If your reason is mostly people love it, or it's going to the moon, you do not have valuation, you have mood. Now here is a simple decision rule that can protect you. If you cannot describe in plain words why your price has room for error, then wait. Waiting is not doing nothing, waiting is risk control. And waiting is also how you avoid one of the biggest dangers in modern markets. Social media makes it feel like you must act now. Like every hour is a chance you will miss forever. That feeling is fake. It is a pressure trick. There will always be another chance to buy something good at a fair price. The market is a machine that never stops offering prices. Some are high, some are low. Your job is to be picky. Now, this is where many people say, okay, fine, but how do I know what to focus on? There are thousands of stocks, thousands of opinions. Every day is noise. That is real. And it is one of the biggest reasons people fail. They drown in info, then they grab whatever feels clear, even if it is wrong. So the next rule is not about math, it is about focus. Rule 5, stay inside your circle and ignore the rest. Your circle of competence is not what you feel excited about. It is what you can understand well enough to stay calm. Calm is not a personality. Calm comes from clarity. Calm comes from clarity. If you buy something you do not understand, you will not know what to do when it drops. You will not know if it is a normal dip or a real problem. You will not have facts. You will have fear, and fear makes you sell at the wrong time. So you mew. Say be honest about what you know. Here is a simple circle test. Can you explain how the business makes money in 4 sentences? Can you name the top reasons it could fail? Can you explain what would need to change for you to admit you were wrong? If you cannot, it is outside your circle for now. And that, for now, matters. Your circle can grow, but it grows by study, not by rushing. Now let's make this practical. Create 2 lists. First list is your yes, I understand this list. Only a few businesses. Businesses you can explain. Businesses you have read about. Businesses you could hold without checking the price every hour. Second list is your not yet list. This is where most things go. It is not an insult. It is a boundary. When you see hype online, you say, maybe it's good, but I don't know it well. So it's a not yet. That one habit saves you from many regrets. Now let's talk about information overload. The market produces endless data, news alerts, hot takes, charts, earnings reactions, predictions. Most of it will not help you. So use this filter question. Will this information change what I do in the next 1 year? If the answer is no, it is probably noise. And noise creates mood swings. Also, watch out for people who speak with total certainty. In markets, certainty is often a sales tool. Real investing is about odds, not certainty. So here is an inner script for your mind when you feel pulled by a strong opinion online. Say, this person might be right, but I do not need to act today. I need to understand. Then ask, what would I need to see to believe this without copying them? If you cannot answer, you are being pulled by confidence, not by facts. Now, to stay in your circle, you also need to stop doing one thing. Stop checking prices like it is a heartbeat monitor. If you check all day, you will feel like yo. You must do something. You will feel smart when it goes up. You will feel sick when it goes down. You will start trading your mood. A long-term owner checks less, not because they do not care, but because they care about the right things. Business progress, not daily quotes. So set a simple rule for yourself. You decide when you will review your investments, maybe weekly, maybe monthly. The exact timing is up to you. The point is to avoid living inside the market's emotions. Now we have covered 3 huge pieces. We protect the seed. We buy businesses, not stories. We demand a moat. We refuse to overpay, and we require a margin of safety. We stay inside our circle and ignore most noise. If you do only these things, you already separate yourself from most people. But we still have a big problem left. Even great rules fail if you break them in a storm. And storms will come. Not once, Many times. Prices will fall fast. Headlines will get scary. People will panic. Others will brag. Your brain will beg you to act. So in the next chunk, we will build the part that most people skip. The part that decides your results more than any stock pick. We will build a simple volatility plan. A plan for fear. A plan for greed. A plan for greed. A plan for when you feel the pull to chase and the urge to run. Then we will finish with the final rules that turn patience into a system. Because compounding is not just about time, it is about staying steady for a long time, and that is not easy, but it is learnable. Storms will come, not maybe, not if. They will come, markets fall, news turns dark, people panic, and the hardest part is that it can happen when you least expect it, even after long good times, even when you feel safe. So Rule 6 is the rule that protects all other rules. Rule 6, build a volatility plan before you need it. Volatility is a fancy word for big moves up and down, but the real danger is not the move. The real danger is what the move does to your brain. When prices drop fast, your brain says, do something. It feels like danger. It feels urgent. Your body reacts like you are being chased. Your hands want to click. Your mind wants to escape the pain. When prices rise fast, your brain says more. It feels like a reward. It feels like proof. You start to believe you are special. You start to believe risk is smaller than it really is. Both feelings can break your future. So you need a written plan. Not in your head, on paper. A plan you can read when your emotions are loud. Here is a simple volatility plan you can use. First, you separate two worlds. World A is price. World B is the business. Price moves fast. Business changes slow. Your job is to notice which world is moving. When the stock drops, ask one calm question. Did the business change or did the mood change? If you cannot answer, that is a sign you did not understand what you owned. And that is a lesson for next time. Now you do a quick check of the business, not the price chart, the business. You ask, are customers still there? Is the product still needed? Is the company still earning real money over time? Is debt under control? Is the moat still real? Is this a short-term scare or a long-term problem? If the answers are mostly stable, then the drop may be normal fear in the market. If the answers are getting worse, then it may be real damage. This is why you write down your reason for owning a business on day one. If you do not write it down, you will make up a new story later. Fear will help you lie to yourself. Greed will help you lie to yourself too. So here is a simple rule. Every time you invest, write a why in plain words. Then write the break points. The break points are what would make you admit you were wrong. For example, you may write, I own this because the company has loyal customers, strong cash flow, and a moat from switching costs. Then your break points could be, if customers start leaving fast, if debt rises to unsafe levels, or if a rival makes switching easy, I will review my thesis again. Notice the word review, not panic, not react, review. Now let's build the red day script. This is what you tell yourself when prices are down and your heart is racing. Say this, a falling price is not a command, it is an offer. I will not act fast, I will check facts. I will decide with a cool head. Then do one more thing. Slow your inputs. When markets fall, the news gets louder. Social media gets dramatic. People start using words like crash, collapse, and meltdown. This is when you must protect your attention. So set a simple rule for red days. No doom scrolling, no watching 10 opinions. You check your notes. You check the business. You step away. Now let's build the green day script too, because greed can also ruin you. When prices are up a lot, say this. A rising price is not proof. I will not get pulled into ego. I will check valuation. I will not chase. Then ask, if I did not own this today, would I still want to buy it at this price? That question cuts through pride. It forces you to think like a new owner, not a fan. Here is another strong rule. Never make a big decision while you feel a strong emotion, not fear, not excitement. If you feel your body buzzing, you wait. A simple waiting rule is 24 hours. You tell yourself, I will not act today. I will act tomorrow if the reasons still hold. Most bad moves feel smart in the moment. Time helps you see clearly. Now you might be thinking, but what if waiting makes me miss my chance? That is FOMO talking. FOMO is the fear of missing out. It is one of the most costly feelings in investing. It makes you buy high. It makes you join late. It makes you accept bad prices because you want the feeling of being included. So you need a FOMO shield. Here is one. Anytime you feel rushed, ask, who benefits from my rush? Most of the time, it is not you. Then ask, if this is a great business, will it still be a great business next month? The answer is usually yes. And if the answer is yes, you do not need to rush today. Now let's talk about panic selling. because this is where many long-term plans die. Panic selling usually happens for one of three reasons. One, the investor took too much risk. They bought more than they can handle, so the drop becomes personal pain. Two, the investor needed the money soon, so they become a forced seller. Three, the investor never understood what they bought, so the drop feels like a mystery, and mystery feels like danger. Rule 6 fights all three. It keeps risk at a level you can hold, it pushes you to keep a safety buffer, and it forces you to understand the business and write your reasons down. And remember this, you do not need to be fearless, you just need to be steady. Courage in investing is often quiet. It is the choice to not do something dumb. Now we reach the final rule. This is where the title becomes real. Not because of hype, because of math and time. Rule 7, turn patience into a system. Turn patience into a system. People talk about patience like it is a personality trait, like you either have it or you don't. That is not true. Patience is built. It is built with systems that reduce bad choices. Compounding is simple. You put money to work in quality assets. You give it time. You add more over time. You avoid big mistakes, and you let the results build on themselves. But the hardest part is staying consistent for years when the world tries to pull you off track. So here is how you make patience easier. First, make your investing automatic when possible. Not because you are lazy, because you are human. If your plan depends on mood, you will break it. Automation removes daily choice. It turns investing into a habit like brushing your teeth. Second, build your boring schedule. Choose a simple time to review your plan. Maybe once a month, maybe once a quarter. That is enough for long-term investing. The goal is to stop living inside daily noise. Third, keep a cash buffer for life. This is not an investing tip. This is a behavior tip. Life will happen, cars break, jobs change, emergencies show up. If you have no buffer, you will be forced to sell investments at bad times. A buffer is what keeps you from becoming a forced seller. Fourth, protect your gap. The gap is the space between what you earn and what you spend. That gap is the fuel for investing. The market cannot compound money you never invest, and lifestyle creep is one of the quiet thieves of compounding. Lifestyle creep is when spending rises every time income rises. It feels harmless because it happens in small steps, but it can erase years of progress. So use a simple rule. When you get a raise, do not upgrade your whole life. Upgrade your future first. Save and invest a part of every raise before you change your lifestyle. Fifth, build a decision checklist and use it every time. This keeps you from making random moves. Here is a simple checklist in plain language. Before you invest in any company, you ask, do I understand the business? Does it have a moat? Is the price reasonable with a margin of safety? Is this inside my circle? Can I hold through a big drop without panic? Do I have a clear reason and clear break points written down? If you cannot say yes to most of these, you wait. Waiting is not weakness. Waiting is discipline. Now at this point, you may be asking the question that many people are afraid to say out loud. Can small money really matter? Yes, small money matters because it trains you. With $300, you are training your mind to think in decades. You are training your hands to not click from emotion. You are training your life to create a gap and protect it. You are training yourself to buy value, not hype. And that training is what scales. The biggest danger is not that you start small. The biggest danger is that you start sloppy. Sloppy investing is like building a house on sand that can look fine on a sunny day, then one storm hits, and you learn the truth. So let's put all 7 rules into one simple story you can remember. Rule 1, protect the seed, because survival comes first. Rule 2, buy the business, not the story. Rule 3, demand a moat, because time only helps strong businesses. Rule 4, require a margin of safety, because the future will surprise you. Rule 5, stay in your circle, because confusion turns into panic. Rule 6, use a volatility plan because the market will test your emotions. Rule 7, build a system for patience, because consistency beats intensity. Now here is the final internet log I want you to keep. When the internet screams fast money, you say, I want lasting money. When people brag about quick wins, you say, I care about not losing. When the market drops and fear rises, you say, mood is not math. When the market rises and greed rises, you say price is not proof. And when you feel small, because you start with $300, you say small is not weak. Small is where discipline starts. This is the part nobody wants to hear, but it is the truth. Most people do not fail because they chose the wrong stock. They fail because they could not follow a good process for long enough. They quit early, they chase late, they sell low, they buy high, they keep switching plans, they keep feeding their emotions. They keep paying the attention tax. They keep paying the impatience tax. Your edge is not secret knowledge. Your edge is temperament. Your edge is being calm when the market is loud. Your edge is living like an owner, not a spectator. And that is how small money can grow into something big over time. Not by magic, not by speed, by steady decisions that make compounding possible. Start with $300, not to prove you can get rich fast, but to prove you can act like a real investor. Because if you can do it with $300, you can do it for life.